Hello everyone, I hope you're all having a great week. My name is Drew, the host of Never Behind. Now, due to the bull rally in 2023, a number of analysts are focusing on choppy 2024, or at least a choppy first half of 2024, with JP Morgan coming out a couple of days ago saying that they see the market going all the way down to 4,200. However, there are so many institutions or banks like Deutsche Bank, BMO, RBC, and Bank of America saying that the S&P 500 can go all the way up to 5,000, and some analysts are even saying that the market can go up to 4,800 by the end of December. Now, in today's video, I want to share the bull case for 2024 from the Bank of America Securities head of U.S. equity and quantitative strategy, Savita Subramanian, and also the bull case from the billionaire investor Bill Ackman, who is the head of Pershing Square Capital Management. Now, since no one can predict the market 100%, both Savita and Bill Ackman's opinion can always be wrong, so please make sure you always do your due diligence before you make any investment decisions. So with that, let's see why Savita and Bill Ackman thinks 2024 can be a very bullish year. Now, before getting into the interview, I just wanted to share that Moomoo is having a great promotion, giving out 15 free stocks, which I think no one should miss. So if you are interested in receiving the 15 free stocks, make sure you click the link in the description below. I've also started a Discord that is 100% free and have great experienced investors regarding stocks, options, swing trading, chart analysis, and also cryptocurrencies, sharing their ideas on opportunities for investments every day. So if you are interested in being a part of the community, please click the link Discord in the description below.
Bank of America anticipating next year will be a stock picker's paradise, with the S&P 500 hitting 5,000 by year end next year, not this year. We've run a long way in November. Maybe we're going to see a pullback on some of these things. You're pretty convinced that things are going to go up from here.
I mean, not in a straight line. I think there is a high probability of pullbacks next year around various areas of concern. But I do think that we're in a healthier market setup than we've been in a very long time. So I'm actually feeling pretty good about the market. I mean, we're not bullish because of what we think the Fed is going to do.
In terms of, you don't expect any pullbacks in rates?
We don't necessarily have a view that's predicated on a big drop in rates. Fed has done a lot of the painful work already, and chances are it's close to over. The market has handled it so far. Sure, there are lagged effects of monetary policy, but if you look at consumers and corporates, I think when we look at things like delinquencies and worry about the fact that they're rising, they're actually just coming back to more normal levels from pre-COVID lows. So I think that we're in an environment where the U.S. consumer and corporates actually look pretty healthy. Consumer confidence might be a little bit rattled by the fact that rates have moved higher, but the bulk of consumers have been able to withstand this pressure. And where we're seeing the pain is more in millennials, which are the prime spending group. But I think even there, baby boomers are right at the cusp of this massive wealth transfer. So if you look at the average age of a baby boomer, it's the average lifespan of a human being. Grim statistic. But what that means is that we are at the beginnings of this sort of wealth transfer from wealthier generation that's sitting on $80 trillion worth of assets to the more strapped millennial generation.
Wait, they're all going to die and give their money to the youngsters?
Well, okay. So, yeah, I mean, one way of saying it is, yeah, I mean, we're at that point where that wealth transfer begins. But then on top of that, I think there's also the idea that baby boomers are even spending more on services and goods than they used to. So it's not just baby boomers are taking over all the wealth and they're never going to spend again. I think that there are cross currents that are actually pretty bullish for consumption. So, yeah, so in the U.S., I think that U.S. consumers are actually in a pretty good position.
We have never seen the Fed raise rates by 500 basis points and have it not result in some pretty severe dislocations. Why do you think this is different?
So I think this time is different for a number of reasons. One is that we were at almost too accommodative rates at the beginning. We were at 0. And going from 0 to 5 is different from going from 3 to 8. I think also on top of that, you had consumers and corporates preparing for a rising interest rate environment. And in fact, they locked in long-dated fixed rate debt obligations at very low interest rates. And I think that's serving them well now. I'm not saying it's going to be gravy from here, but I do think that the one kind of positive where we are today versus where we were a couple of years ago is we know how the Fed is going to get get off of ground zero in terms of interest rates. We're already past that point. We've seen massive inflation volatility, and inflation volatility, we know inflation isn't going to be zero. It's not going to be 10, but it's going to be somewhere in between that range. And on top of all of this, we also have an environment where U.S. companies have begun that process of moving IP tech equipment out of China and less friendly regions of the world back to the U.S. So I almost feel like a lot of the work is behind us rather than ahead of us, and now we can kind of get a better grasp on what earnings are going to look like.
We were at 4,800 in 2021.
We were.
So your big bullish case gets us to 5,000 by the end of 2024. So 3 years later, we have a total S&P return of
not that much,
3 or 4%.
Exactly.
That's not.
And what's surprising?
That's not a very crazy call.
It's not a crazy call,
but it's also only 10% next year.
It's 10% returns next year, which is a
couldn't we do
little bit
20?
above average. I mean, I think we could do 20. It depends on the shape of the consumer. It depends on confidence. But I think the idea is we're, one of the higher forecasts on Wall Street, and we're not that aggressive.
Now, Savita is saying that the market has a very healthy setup, and it was interesting when she said that her thesis does not have to do much with what the Fed will do next year. She was saying that the Fed has already done the painful work and is near its end, and that surprisingly the market is doing quite well even with the high inflation and the Fed fund rate hike. And therefore, if the market can handle that environment, the market will do very well next year because it's going to be a better year than the years that we had when the Fed fund rate was rising aggressively. I also thought that it was very interesting when she mentioned that the generation that is having the hardest time right now is the millennials. But we have a wealth transfer happening from the baby boomers to the millennials, since the average age of the baby boomers are near the end of their life expectancy. In other words, as the baby boomers pass away, the wealth will be handed over to the millennials, which then they will be able to keep spending, and therefore the market will be a healthier market than most are expecting. Now, based on our estimates, the baby boomers will be handing over approximately $80 trillion. So if that is the case, she might have a good point there. But again, we will have to see if the wealth transfer works out as she thinks. She also had an interesting point when she said that the reason why we will not see a market crash after the Fed hiking rates this fast aggressively is because, first of all, we started at an interest rate of almost 0%. So even if percentage-wise there was a huge increase in the Fed fund rate, the actual numbers are not as bad as people think, since it's not like the Fed fund rate went from 5% to 15 to 20%, but from near 0% to approximately 5%. Now, I personally do not agree on this part, since there has been many real estates and banks that got loans and bought bonds when the Fed fund rate was pretty low. And if the Fed keeps this high level for a long time, it will have a huge impact on the commercial real estate and banks, and also on the majority of corporations that have a lot of debt, in my opinion. Now, Savita also said that the consumers and corporations were already anticipating a rise in the interest rates and were prepared, and therefore it is different this time compared to the past markets when the interest rates went up this high and this fast. I guess we will have to see if this time it is really different. As Savita says. Now, let's hear why Bill Ackman thinks the market can go higher in 2024 and why he thinks the Fed will have to cut the interest rates much faster than most people are anticipating. I really think that Bill Ackman's view and rationale on why he thinks the Fed will have to cut the Fed fund rates much earlier than most people think made a lot of sense, and as he says, if the Fed does not reduce the rates pretty soon, I also think that a hard landing would be inevitable. So make sure you listen to the end to hear what Bill Ackman has to say.
We probably have avoided a recession for the near future. We're going to have a so-called soft landing. That's the consensus. Is that your view as well?
I think it's really hard to predict. I do think the economy is weakening. We're seeing, evidence of that in some of our companies, and I have some concern. What's going to be interesting is to see what happens when people have to reprice their debt, and I think that can have sort of a cliff-like effect, and you're certainly seeing that in real estate.
Now, the markets are assuming, and the markets are not always right, but the markets are assuming that there's going to be a Fed discount cut sometime next year. And as we talk now, just about the end of November, it's not clear what the Fed will do, but you have a view on what the Fed's likely to do?
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives and inflation is, trending below 3%, or, that's a very high real rate of interest. And I think that is having a sort of retarding effect on the economy. And then, of course, again, many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.